What is 50-30-20 rule of budgeting? Budgeting for beginners. Do you struggle with creating and sticking to a personal budget plan? Maybe you can't resist going to the Apple Store when a new iPhone comes out. Or maybe you find it challenging to prepare food when UberEats sends you a new promotion on delivery. Well, fortunately for you, there is a new personal finance trend that can assist you: the 50-30-20 budget rule. The 50-30-20 budgeting rule works well for both novices and savvy spenders who want to manage their personal finances. Interested in knowing more? Drop a like and hold on to your seats as we will reveal how to use this 50-30-20 rule of budgeting in your favor. To better understand how and when to apply this rule, we'll look at its origin, how it works, its benefits and limitations, along with a few examples. Also, make sure to stick around till the end of this video where we'll share with you a step-by-step guide on how to apply the 50-30-20 rule in your daily lives. Now, on to the video. What is the 50-30-20 rule? The 50-30-20 rule is a simple and sustainable budgeting framework that can help you get a grasp of your financial situation more effectively. The general rule is to split your monthly income after taxes into 3 groups: 50% for needs, 30% for wants, and 20% for savings or to pay off debt. By consistently maintaining a balance between these major spending categories, you can put your finances to a better use. As an added bonus, you won't have to sweat the small stuff by keeping track of every cent because there are only 3 major categories to monitor. When it comes to budgeting, one of the most common questions we get is, why can't I save more? The 50-30-20 rule is a fantastic method for putting more order into your financial life and finding the answer to that age-old conundrum. Whether you're trying to build an emergency fund or pay down debt, it can help you get closer to your monetary objectives. How did the 50-30-20 rule originate? It was in 2005 that U.S. Senator Elizabeth Warren and her daughter Amelia Warren Tyagi popularized the 50-30-20 rule in their book, All Your Worth: The Ultimate Lifetime Money Plan. Warren and Tyagi believe, based on more than 20 years of study, that a simple budget is sufficient for achieving financial stability. Using the 50-30-20 rule, you may easily allocate your resources fairly among meeting essential needs, satisfying wants, and building savings. How to budget your money with the 50-30-20 rule? The 50-30-20 rule simplifies budgeting by splitting your income after taxes into just 3 spending categories: your needs, your wants, and your savings or debts. It will be much simpler to stick to your budget if you know exactly how much money you have to spend in each category. The 50-30-20 budget breakdown is as follows. Spend 50% of your total money on needs. In a nutshell, needs are unavoidable expenditures, payments for all the necessities that you cannot live without. Your basic living expenses should not exceed half of your disposable income. Needs may include paying monthly rent, utilities like electricity and gas bills, transportation expenditures, insurances, for example, healthcare, car or pets, minimum loan repayments, basic groceries and food items. For instance, if your monthly income after taxes is $2,000, you should spend $1,000 on your needs. The amount each person set aside may vary. Spending more than half of your money on necessities is a warning sign that you may need to reevaluate your spending habits. Changing energy providers or discovering new strategies for saving money at the grocery store are 2 examples. More substantial adjustments to one's lifestyle, such as the search for a cheaper place to live, may also be necessary. Spend 30% of your money on wants. If you spend half of your disposable cash on necessities, you'll have 30% left over for luxuries. For the sake of this definition, wants refers to those expenditures that are not strictly necessary, but that you would nonetheless like to make despite the fact that you could get by without them. Wants may include dining out, clothes shopping, holidays, gym membership, entertainment subscriptions, for example, Netflix, HBO, Amazon Prime, groceries other than the essentials. Continuing with the previous example, if your monthly take-home pay is $2,000, you have $600 left over each month to spend on your wishes. If you find that you are spending an excessive amount of money on your wants, it is wise to evaluate which ones you can do without. Note that you can still have fun while adhering to the 50-30-20 rule. It's as easy as becoming more aware of your spending habits and cutting back where you can. In order to determine whether spending is a necessity or a want, you should ask yourself, could I survive without this? If your answer is yes, then it's probably a want. Keep 20% of your money for savings. After spending half of your money on needs and the 30% on wants, you'll have 20% left over for investments, debt repayment, or savings. All payments above the minimum are considered savings because they reduce the principal and the interest owed. Putting aside 20% of your paycheck regularly will give you a solid foundation on which to create a long-term savings strategy. This is the case whether you're saving for a rainy day, putting together a retirement fund, or saving for a down payment on a property. And the cumulative savings is considerable. For example, if you take home $2,000 monthly after taxes, you'd have $400 available for savings. You'll have nearly $5,000 in savings after just 1 year. Step-by-step guide to apply the 50-30-20 rule. So, how do you put the 50-30-20 rule into practice? To use this simple budgeting rule, you'll need to figure out your income and divide your spending into the 50-30-20 ratio. Here are 3 steps that you need to follow. Number 1, first you have to calculate your after-tax income. In order to apply the 50-30-20 budgeting rule, you must first determine your net income. If you're a freelancer, your after-tax earnings will be what you make in a month minus your work expenses and the amount you've set aside for taxes. It'll be less of a hassle if you have a regular paycheck from a job. Look at your pay stub to get an idea of how much money you bring in per month. Payroll deductions for things like health insurance and retirement savings should be added back in. Number 2, categorizing your expenditures for the past month. Examining your spending habits over the course of a month can give you a good idea of where your hard-earned cash goes on a regular basis. Classify all of your purchases by headings like salary, food and groceries, entertainment, and so on. Finally, divide all of your spending between necessities, luxuries, and savings. Keep in mind that needs are those things that you really have to have in order to survive, such as food and shelter. A want is an extravagance that you could do without, like going out to restaurants. Money put away in savings can be used to pay off debt faster, invest for the future, or cover unexpected expenses. Number 3, evaluating and adjusting your spending to match the 50-30-20 rule. Now that you know how much of your income goes towards necessities, discretionary expenses, and savings per month, you can begin to change your budget to adhere to the 50-30-20 rule. The most effective method is to calculate how much money you spend monthly on wants. If you follow the 50-30-20 rule, your wants aren't frivolous, but rather necessary to your quality of life. Rather than trying to figure out how to reduce your spending on necessities, which can be a difficult and time-consuming process in and of itself, it may be easier to focus on reducing your spending on wants until you are able to do so while still keeping your spending within 30% of your total income. If you want to save 20% of your income, cutting back on your wants is the best way to do it. Use this budgeting strategy to make savings and debt payments regular occurrences in your life. Depending on your income and the prices of your essentials, it may not be possible to stick to the percentage allocations in the buckets to the letter. Overspending can be reduced if you use the bucket amounts as a guide. If you find that you are spending too much money on subscriptions or eating out, you can change your spending habits accordingly. Using a budgeting tool to keep track of your expenditures and savings automation might further streamline the 50-30-20 budgeting strategy. As an example, the Mint app may sync with a user's bank account to keep tabs on spending, as well as remind them of upcoming bill payments. After determining how much money you'll need to cover bills, pay down debt, and indulge your desires, entering that information into a budgeting tool will help you see your expenditures and savings in a more concrete light. Most checking accounts allow customers to schedule repeating transactions on the same day each month, making monthly savings automatic. The majority of professionals will agree that budgets are more likely to be effective and adhered to if they are somewhat malleable. It doesn't matter if you choose the 50-30-20 rule or some other budgeting strategy. What matters is that you know how much money is coming in and going out, and that you modify your spending accordingly to achieve your long-term goals. So, do you think the 50-30-20 rule is achievable or not? Tell us in the comments. Also, if you want us to feed you informative videos like these, don't forget to drop a like and subscribe to the channel. See you in the next one.